Welcome, everyone, to the Information's TITV. My name is Cory Weinberg. I'm in for Akash Patricha, and it is Monday, October 27th. TITV is in California, the Golden State, the next few days, just like the World Series. I'm coming to you from my home in Los Angeles, just 3 miles from Dodger Stadium. Tomorrow, Akash will host from the Adobe Max conference in LA. And on Wednesday, Natasha Mascarenhas will take the mic from Napa Valley at the Information's Women in Tech, Media, and Finance conference. Looking ahead, we have a trifecta, a big tech news events this week. It's going to be busy. We have NVIDIA's GTC conference in Washington, D.C. starting today. Most of the rest of the Magnificent Seven reports earnings this week, starting tomorrow. And we will have a tech IPO. Corporate travel startup Navan is likely to ring the bell at the New York Stock Exchange later this week. We'll have plenty of analysis on those stories later in the week. Today, we're sticking with the private markets, my favorite subject. We'll discuss a debate on fund concentration that is cropping up in venture capital. We'll talk with our reporters about OpenAI's push into AI-generated music. That'll be interesting. And I'll interview the CEO of mental health unicorn Spring Health. But let's first get to our first guest and our first segment on the growing startup secondary market. We have Javier Avalos, the CEO of Caplight, one of the data providers that tracks the secondary market most closely. And we have Hans Swildens, CEO and founder of Industry Ventures, which just agreed earlier this month to sell itself to Goldman Sachs in a deal that could be worth up to $965 million. Javier and Hans, welcome to TITV.
Thanks, Cory. Good to see you.
Hans, you're a returning guest to the program. Your firm is, I think, about 25 years old, and Goldman CEO David Solomon pointed to the fact that Industry was a pioneer in secondary venture investing as a reason to want to pick you guys up. Set the backdrop for us here. What's happening now that makes secondary investing more important to the venture capital ecosystem?
Thanks again for having me on. I appreciate it. So yeah, we've been pioneering the secondary market for 25 years. Started originally when the dot-com collapse happened and helped build a secondary market for venture and tech growth. And one of the reasons why Goldman was interested in partnering more deeply with us and acquiring our firm is that we've worked with them along this whole journey since over 20 years. As the market's developed. And I think we've reached an inflection point here, and they would agree that the market is large, growing, and not going away. It's a structural component in the market of how venture funds, limited partners, corporate investors, hedge funds, mutual funds get liquidity. Similar to how Goldman pioneered the IPO market in terms of helping raise capital and getting liquidity for shareholders a long time ago. Our firm was one of the pioneers pioneering the secondary market to generate liquidity.
And that market is obviously growing. Javier, Caplight, your firm, reported last week that it saw, I think, a 29% increase in month-over-month transactions in the secondary market in September, and trading volume was up by about half so far this year. What's driving the growth?
Yeah, that's right, Cory. It's been a huge year so far for the VC secondaries market, and as you mentioned, about 50% up on a volume basis from where we are this year versus where we were last year, same time. As far as what's driving the growth, we really see three things. I mean, one is access. This little thing called AI has very quickly shifted the VC paradigm, where there are only a few funds in the world that can get pure AI exposure. And so the secondary market has popped up as one place where you don't have to be one of the top 10 venture funds in the world. You can still go and find an avenue to get exposure to some of these really hot AI companies. On the back of that, rounds are getting larger and larger. as a solution for venture funds potentially not having billions of dollars of dry powder just sitting around, but wanting to participate in some of these massive AI rounds. We're seeing an increase in SPV transactions with a lot of money flowing through special purpose vehicles to get into some of these severely oversubscribed funding rounds. And then valuations are high. We've hit a new peak following the 2021 to 2022 venture correction. With that peak comes folks who were invested early, who are seeing the venture secondary market as an opportunity to get some DPI, return capital to their investors, and keep the VC ecosystem flowing.
So is it fair to say that the relatively dormant IPO market has been pretty good for both of your businesses? Like how is that sort of feeding into the growth that you're seeing in the secondary market?
Yeah, happy to start this one off. I think there's a common misconception that when the tech IPO market is hot, that's a negative for the venture secondaries market. It's actually the opposite. When there is an active IPO offering IPO window, that tends to be when we see additional dollars coming in on the buy side of the venture secondaries market. We saw it in the 2021 cycle. We're seeing it again this year. I think as long as there's not a situation where every unicorn hits the exit at the exact same time, which it doesn't make sense for that to happen, you can see positive IPO activity correlated with like strong secondary market environment.
And I want to get a little bit into how this market actually functions. Hans, how have you seen sort of the secondary market mature? How does it still need to go from here? Venture has generally been behind, I think, the private equity industry and sort of building up the infrastructure around secondaries. Sort of what are you seeing in the last couple of years that signals maybe that maturation process is happening?
Yeah, I think that's a really good point. When you look at venture and growth, it's been delayed from private equity development and sophistication in terms of getting liquidity, and so we've always played catch up, honestly, to the private equity markets. That includes real estate, infrastructure, credit, kind of alternatives, in the bulk of its buyout. But in terms of what we're seeing in our market, the new kind of area of the market that's growing rapidly is continuation funds. This is an area of the market that grew rapidly starting about 10 years ago in the buyout market. And we just started feeling that growth in the last couple years. And so what you'll see is more and more liquidity structures coming from the buyout market that were already kind of accepted, being applied into the venture market. And so continuation fund, if you don't know what it is, it's a fund that it's basically an old venture fund or a portfolio of investments that is recapped or restructured to continue the management and funding of the portfolio companies and holding them longer. And so we saw almost a dozen of these last year. In our market, we'll see probably 24 this year, maybe 36 next year. And the thing that's really interesting about them from a growth perspective, in terms of our market sizing, is that these transactions are very large because it's a whole portfolio of traditional venture fund ownership, which as you know has large ownership stakes across a number of companies, and so the transaction sizes are larger. So we're seeing transaction sizes become larger and larger over the last few years, and we think that'll continue, so that it will drive more market growth in terms of total TAM.
Do LPs like continuation vehicles? Like, are they voting for these, or are they signing up for these?
Yeah, I think that the buyout market had that period of time where LPs didn't really know, right? Is this a good thing or bad thing for the buyout market? And what they all settled on was it was a good thing because it gives LPs an option to take liquidity or not take liquidity. It gives the GPs an option to continue holding the investments to maximize the value. And as an LP in a venture fund or in a portfolio, you're not forced to sell into the continuation fund. You can check a box and say, I'll roll into it. And therefore, you're not affected and you can continue your ownership. You just switch from the fund that you're in to the continuation fund, or the fund you're in becomes the continuation fund. So there's a couple different structures of how you structure the actual continuation fund legal process, but you can just keep going. And so LPs have settled on the fact that they like it because they can take liquidity or not take liquidity. They can take partial liquidity, full liquidity, or not take any. And that's honestly what you need to offer folks to have a good, fair functioning market.
I quickly just want to hit on some of the tensions in this market. Some of the hottest AI companies often don't want that many secondary trades happening without their involvement. They'll reject potential trades brought to them, or exercise their right of first refusal. I had a story today about how Anduril is how hot they are in the secondary market, and their COO I quoted as saying, anyone claiming they can offer Anduril secondary shares is probably misrepresenting the facts and may be defrauding buyers, to say nothing of charging layers of egregious fees. Does he have a case? Like, what are the tensions that lie here with some of these companies, Javier, and how are buyers navigating it?
Yeah, I think he does have a case, and I thought your story was really well written. I encourage folks to read it. The stakeholders here all have their own thing that they're solving for. For the companies, that's making sure that investors on their cap table are of a quality that they care about, and it's also preventing distraction from operating the company and therefore sort of running these processes in somewhat orderly fashion. I think because of that, any ad hoc trading of this stuff or any trading that could cause the company to lose control is automatically going to be like a really sensitive point for the company. And I think that makes sense. At the end of the day, this market exists to get liquidity for some of the earliest investors, the risk takers that are kind of backing these companies, as a solution for them to sort of return cash to their investors to keep the whole ecosystem going. The secondary market needs to exist as like a release valve for when pressure builds up, where liquidity is a must-have, but it needs to be done in somewhat orderly fashion. And so I think over time you see more companies leaning into like more systematic programs for offering liquidity. You see companies that are open to doing special purpose vehicles for syndication, but in a much more controlled manner, where the company's getting the ability to kind of okay participants in each SPV. And if there is going to be ongoing continuous trading, you have companies that are sort of opting in for that. And to be clear, we don't have that yet. Like there is no NASDAQ or New York Stock Exchange for private companies just yet. But I do see that happening in the future.
Well, there'll be a lot more to dig into there. Javier and Hans, thanks for joining me. This is one of my favorite topics, so thanks for the conversation. All right. Well, in glass-walled boardrooms across Sand Hole Road and in San Francisco's South Park, venture capitalists and their limited partner backers are debating the basic question: what kind of firm are we? Some firms are in search of scale, amassing a huge amount of capital that they spread out over a wide set of startups. Others are sticking to the more boutique roots of venture capital and making more concentrated bets. One VC thinking and writing about this debate is Phin Barnes, who co-founded the San Francisco-based early-stage VC firm, The General Partnership, after a long tenure at First Round Capital. He wrote a blog post last week called Alpha VC versus Beta VC, the two competing logics of venture capital. Phin, welcome to TITV.
Hey, Cory, good to see you. Thanks for having me.
So, yeah, of course. Yeah, thanks for coming in. Are you dialing in from your SF office?
Yeah,
the glass-walled SS office. Okay, good.
Yeah, glass-walled.
So what is an alpha VC and what's a beta VC, and why is this debate happening now?
Yeah, so I was actually talking with a couple founders who were trying to decide how to think about the partnership they would form in their next round of financing, and they were trying to figure out the difference between the offers that they had, the type of partnership they would form. And they started talking about the incentives of those partners, the way the firms operated. And it just became clear to me that as the market continues to mature, and as you're just talking about with the previous segment, we're sort of seeing all these new financial products get created in the private markets. It feels like there's a bifurcation, and that certain firms are sort of chasing market coverage, and other firms are chasing very specific sort of idiosyncratic founders within a market, believing they can outperform. And so I think the difference to me became sort of a pretty simple split between people seeking alpha and people looking for market exposure and generally providing access to beta, meaning access to the broader technology private markets to their investors.
Right. Okay. So you mean alpha and beta from like a financial term perspective.
Yeah.
Okay. And so what are
No
examples?
judgment whatsoever. Just
Right. Okay. I can, as someone, you're on the side of the alpha, I think. So no judgment for sure. Well, I want to go a little bit into your firm in a second, but first, what are some examples you see more broadly, sort of around across the market that VCs are talking about, like examples of these two approaches? Maybe firms would not admit to taking necessarily just one versus the other, but sort of what are examples we might recognize here?
Yeah, so I think it's operating style. I think you look to smaller partnerships, tending to be top heavy, senior partners who are still very active, making larger investments relative to fund size into a smaller number of companies, working more deeply with those companies and forming long-term partnerships with them, I think is sort of the alpha approach. And regardless of stage, I think it really plays out in terms of concentration of time and capital relative to fund size and the 24 hours that everyone has in a day. And then I think on the beta side, you tend to see more pyramid structures and firms that, as they continue to evolve, look increasingly similar to large asset managers from Wall Street. And as we saw the evolution of private equity, you sort of saw this play out there as well. And I think you see large teams, you see market maps and coverage banking approaches, hustling not just to meet the one company that you really believe in, but to meet the 10 others that you believe fit that same box in your market map, and then choosing amongst them. And you also see fast following. So if a leading beta VC firm sort of designates a category as legitimate by investing in it, you'll see fast follows from many of the other beta firms into that same category, or companies that are competing for that same market, because none of them can afford to. If you're a beta investor, you can't afford to miss the drivers of the market. At least you fall behind the benchmark.
Are you going as far as arguing to founders when you're talking to them, like, hey, don't take money from a big multi-stage firm?
No, I don't think. I think founders should just know the choice they're making. And I think you can form fantastic partnerships with beta VCs, and you can form fantastic partnerships with alpha VCs. And it really depends how you want to build your company and where you think your needs lie in terms of resources and approach.
Viewers may not totally know about your firm. Can you walk us through what the strategy is at the GP?
Sure. So we say we're a talent-centric firm, and that really comes from the DNA of the firm comes out of the talent side of the startup ecosystem. So my partner, Dan Portillo, one of the best talent partners in the Valley until he started investing at a firm called Sweat Equity Ventures after he came out of Greylock. And then we joined up and formed the GP. And we maintain this approach of a very concentrated portfolio, spending a tremendous amount of time with founders and providing service across talent. So recruiting to build your team, go to market, helping you find revenue, and then product and engineering, helping build the technology that underlies the business. And we do that in a unique way where, rather than a pooled resource of a platform team that is paid for with fee, we invest resource into a team of builders that are deployed into these companies for high context, deep engagements where they're working in a dedicated basis. And in exchange for that, we earn common equity grants in the form of advisory.
Okay. So it strikes me that to be a so-called alpha VC and to take this more concentrated approach, you better be right, or you're going to blow up a lot more capital than if you're taking kind of a market exposure or beta approach. What's the best evidence you have so far that your approach, or an approach like yours, is working? Is there empirical evidence? Is there firsthand evidence? Sort of what
I feel like I think you're correct. And when you look at the firms that are able to concentrate capital into a small number of companies, if you look, I think those will drive the best returns in terms of multiples and probably IRR as well. When you look at VC portfolios over time, I think what you tend to see is there are a few companies within any given portfolio that drive the majority of returns. That's been the historical precedent. And so if you can choose those companies and pour capital into them versus a broad-based market performance metric, I think you can outperform. You also can miss and underperform the market in dramatic ways. But I think when you think about the decision of an investor now, a capital allocator, to choose VC, the role of VC within their portfolio is quite different if that VC is seeking alpha versus the beta VC. And so when you're an LP and you're choosing where to place your capital, the role of that partner in your portfolio really matters quite a bit.
The last thing I wanted to hit here is how sort of the current dynamic around AI startups affects this mindset or this different strategy. Because like another thing I hear from VCs these days, along with this debate, is how it's harder than ever to figure out if revenue in an AI startup is sticky or durable. And I feel like when you go big and concentrated into a category or into a startup, that kind of uncertainty I would think would loom large. How does that, sort of how are you thinking through, that question of is some of this like AI revenue actually going to be there in a few years?
Yeah, I mean, I think the both alpha VC and beta VC face that same question as you're making your investments. Much of the market today is in these AI companies. And I think the customers for these companies were at a stage, we're so unimaginably early in this technology and the adoption of this technology that I think the reason we see a lack of stickiness or uncertainty around the quality of revenue is because from a customer perspective, from a buyer perspective, we're still at a place where every user is told, use as many tools as you want and you have unlimited budget. And so I think it's very hard to tell when looking at revenue if you have something that's sticky and durable, or if you have something that's being used as part of an experiment. There were many fewer zeros involved in the market, but ad tech went through this, I think, in the 2009 to 2011 time, when every large brand wanted to find a new ad unit or try a new DSP or ISP. And I think we're seeing the same thing when it comes to whether it's AI coding, AI marketing, AI-enabled CRM, et cetera. Everybody is allowed to try everything. And I think the winners have really yet to emerge.
Well, Phin, we'll check back. Let's check back every few months, or at least every few years, to see how this debate is playing out on alpha versus beta VC. Phin, thanks so much for joining us. Phin Barnes from
Good to see you.
GP. Good to see you too. Well, OpenAI's chorus of products has swelled to a web browser, shopping recommendations, of course, the video generation app Sora. Now it's working on music generating AI that would allow users to create songs from scratch. One of our reporters, Erin Wu, was one of the journalism maestros behind that story on Friday, and she joins me now. Hey, Erin, welcome to the show.
Hey, Cory. Thanks so much for having me.
Of course. So what is OpenAI working on for music? What is your story talking about here?
Yeah, so OpenAI is starting to work on AI that could generate music. It's hard to tell like how far along they are towards this, but they've started working to collect the kind of training data that they would need to receive. So they're working with Juilliard students to have them annotate scores to produce training data. They're also starting to discuss the idea of being able to generate music from text or audio prompts. So that can mean something like having a track and then wanting to like add guitar or add piano or something like that.
Okay, and yeah, I've been using like the ChatGPT voice, and I did test it out to see like would it actually play me a song if I asked it to, and no, it did not. So this is not something OpenAI currently can do. Is that right?
Yeah, that's correct. So they've done some work on music in the past. They've released two models years ago prior to ChatGPT, NewsNet in 2019 and Jukebox in 2020. Neither of those are currently available for users. And then they also have some speech to text and text to speech models that would have some overlapping capabilities because it's about generating audio, but they don't currently have something where you can give it a prompt and it'll spit out a full song.
This sounds challenging, but like video almost sounds like more difficult in a way, or like why is music potentially sort of a challenging category for them or any other sort of AI model?
Yeah, so I mean, music is something that has been a focus of a lot of startups. Like Google also has a music model, so Suno and Udio are probably the best known startups for this. It's something that's exciting for Google, for example, because they have been really touting this ability for marketers and to be able to use it in advertising. And OpenAI has kind of started talking about a similar thing, the idea that it's something with a lot of commercial potential.
Okay. So do you think this would put, I guess we don't know yet whether this would be geared towards more commercial users or marketers or individuals to kind of tack on to their ChatGPT subscription?
Yeah, I mean, I think we don't know specifically, but looking at the kinds of products OpenAI has released so far, like I think it's a safe bet to say that this would be for like all of the above.
Okay. Now this is sure to generate a ton of controversy, like a lot of OpenAI product launches, as it moves closer, if it launches, if they're able to figure this out. Obviously, there's a lot of people around, yeah, around where I live in Hollywood or elsewhere that is going to take a lot of issues with the potential copyright, with their music being stolen or used in OpenAI's training for a music product. They're going to be like, hey, that sounds a little bit like a melody I came up with. What do you have sort of an understanding of is the kind of copyright issues around
Yeah.
sort of music generation?
Right. So, I mean, the music industry is very powerful and also famously very litigious. And so they've already sued the two leading startups in the space, Suno and Udio. Essentially, and I mean, this is similar to what's going on with other kinds of training data. The startups are claiming that what they're doing is fair use. The labels are contending that what it amounts to is theft. Like that said, though, it's not that the labels are pursuing like a purely litigation based strategy. There's also been reporting that they're in talks with some of the startups working on this. So like Suno, Udio, Google. And from my reporting, like OpenAI has already started making advances to the music industry. So we saw the Spotify integration, for example, where users are able to use ChatGPT to queue songs. And from my reporting, they've also been in talks with at least one of the major music labels. And so OpenAI is obviously in a deal making mode. And I think the labels also, from their perspective, see a lot of value to the idea that, okay, like maybe there could be some kind of partnership. Maybe AI is something that could be good for helping people discover music, for example. So there is definitely some openness on all sides.
Has Google run into any particular issues here with their product? I would think that they would be a little bit more risk averse or legally,
Yeah.
sort of cautious than someone like an OpenAI.
Yeah, so there's nothing that's publicly known about where Google is in its AI data licensing discussion specifically, but Google does have an existing relationship with the music industry through YouTube, which is very important to that product. And so like they have some of that relationship already built to be able to strike these deals.
All right. Well, Erin, thanks so much for joining us. This was a fascinating scoop, and thanks for coming on and talking to us
Thanks for
about it.
having me.
Well, we're in an era where AI is obviously reshaping not just music, but every other part of our lives, including how we take care of our health. Spring Health is one company. It's a unicorn working to transform mental health care by using data and AI to create a more personalized experience. It's analyzing thousands of signals to match individuals with the right kind of support more quickly. And joining me now is the co-founder and CEO of Spring Health, April Koh. April,
Hi,
welcome to TITV.
hi, thanks so much for having me.
Thanks for coming on. You guys have been around since about 2016. I feel like your journey has been a really interesting one, especially now in the world we live in. So set the scene for us. How are LLMs affecting mental health providers kind of broadly? How is this affecting a company like yours?
Yeah, well, first off, I just want to quickly introduce, the company and what we do. So we're a global comprehensive mental health platform that makes it really easy to get mental health care that works for you. And 9 years ago at Yale, I started the company with the world's leading expert on computational psychiatry. So he was an expert in AI and mental health. And he was actually the first to prove that we could match people to the right care for them from the start using machine learning. And so fast forward to now, we're one of the fastest growing, if not fastest growing mental health companies out there. We serve, 20 plus million lives with some of the world's largest employers and health plans like Microsoft and Target. And for their employees and their family members, we match them to the right mental health care for them. So it might be coaching, might be therapy, it might be medication. We really use our data to figure out what would be right, and then we match them to the right provider for them, and then we deliver same day, next day care virtually or in person. We're really excited about the potential for LLMs to change mental health care completely. Mental health care has evolved over the centuries, but really in some ways stayed largely the same. So, you generally see a therapist for, let's say, 45 to 60 minutes, and you have a session with them, and then 2 weeks later you're back in their office, or taking the session virtually. And really that format has stayed the same over the past few centuries. Now with LLMs, the care can go from contained within these sessions to continuous. And so we believe that in addition to talking to your therapist in these sessions, you can engage with an AI companion in between the sessions to make your care continuous. And that's something that we've launched earlier this year as well. So we're really, really excited for the potential for LLMs to change the landscape of mental health care completely.
And going back to kind of how you've been using AI to, sort of determine what the best intervention is, or kind of what the best service is for people to use. What signals are you looking at? What signals are kind of the strongest that you use to kind of determine that?
Yeah, so the founding research was really showing that self-reported questionnaire data in and of itself had a lot of signal to match people better, to match people to the right treatment for them better than a psychiatrist working alone could. And now, the big differentiator behind Spring and what makes us truly different and unique is that we have a single platform where every provider, so we have 13,000 global providers, every user and every customer is all on the single platform. And we're gathering data from the providers and the users, from their sessions, from the provider's notes, from the customer's organization. We're bringing this all together on one platform. And every single data point contains signal for how we match people to the right care for them, how we treat them through their course of care, and how we drive the fastest recovery possible for them. So this is incredible technology. It drives 2 times faster recovery than our nearest competitor. And so really represents the most effective mental health care out there.
And you recently announced the release of Vera MH, a new open source test for mental health chatbots. How does it work? How is AI used overall when evaluating someone's mental health?
Yeah. So, look, so we were an AI company from the start, as I mentioned. But when generative AI came on the scene, we fully embraced it because it's conversational in nature. Therapy, the main modality is conversational. So it really made sense that LLMs would completely disrupt mental health care and the format of mental health care. But when we started to innovate with generative AI, we approached the innovation like we approach everything at Spring Health, with a science first mentality, with a mentality towards clinical validation, and an approach that puts member safety first. And what we found was that there were virtually no guardrails or oversight or standards around AI and mental health when we started innovating with generative AI. And so we said, this is a huge problem. Half of US adults say that they use LLMs or chatbots to support their emotional or mental health. And there's virtually no oversight over the use of these AIs for mental health. And so we said, look, we need guardrails. We're not going to slow down on innovation just because these guardrails don't exist. So we created these guardrails in partnership with an expert AI council that we put together of ethicists, technologists, clinicians, the foremost academics on the topic. We pulled this council together and we said, look, let's create a benchmark together. Let's govern it through a neutral third party. And let's make sure that we're setting real standards for AI and mental health. And so that's what we released just this past week. VERMH, it stands for Validation of Ethical and Responsible AI in Mental Health. And the way that it works is really neat. It's open source, so it's really meant to be built in collaboration with the rest of the industry, and essentially it's automated. So instead of having to run a really long academic analysis on whether an LLM or AI is safe, it takes the LLM in question and it uses an LLM to mimic a user, and then it also uses an LLM to judge the conversation that's happening, and it assesses the LLM's ability to ethically and responsibly, deliver emotional and mental health support. So it's a really cool system that we've created in collaboration with this expert council, and we really hope that the entire industry embraces it as the leading benchmark for the space.
You've obviously put a lot of care and effort into developing this. What worries you the most about how people are turning to LLMs to supplement or to actually provide mental health care? I mean, these are companies that are particularly the main model providers that have put out a lot of statements about how they're trying to tailor their systems to do a good job of this kind of work, but they're trying to do a lot. They're all trying to develop the best model. Period. They're trying to attract customers and be sort of a helpful service for a broad range of uses. Mental health is a really obviously difficult sort of intervention to use. I mean, how are you thinking about this from a sort of as someone who cares about this issue? Is this all good, mostly good? Walk me through some of that on a real world basis.
Look, I think that LLMs have the potential to completely transform in a really positive way mental health access, mental health care, and so we're fully embracing it at Spring Health. It's definitely very powerful. But I think that the thing that keeps me up at night is people don't understand that there are no regulations or oversight over the use of these tools for mental health specifically. And unfortunately, a lot of youth, a lot of teens, a lot of US adults are engaging with these chatbots specifically for their mental health. And they think that it's enough to just prompt the AI or the LLMs to be like a licensed clinician. But the reality is, everyone should know that these LLMs are kind of like, you should think about them as like friends. They're probably like a friend that's very knowledgeable, very smart, but also not licensed, right? And not trained or held accountable to the same ethics standards and clinical standards of mental health clinicians. And so that is for me the thing that keeps me up at night. People just do not understand that there is no oversight or regulation. All of this development and innovation is happening behind closed doors. And so that's why we have a huge call to action to the industry with VeraMH, where we say, let's open up the benchmarks that we're all holding ourselves accountable to. Let's co-develop these standards together, and let's all work together to make sure that we're doing right by society and humanity.
What's the one sort of either new regulatory sort of approach or intervention, or sort of what is the sort of rules of the road that you hope kind of gets put in place here?
I hope that everyone will contribute to this open benchmark. So this is open sourced by design. It is. So we released the framework last week, and we're actively soliciting feedback. So we want not only the LLMs, but also academic leaders, clinical leaders, everyone to join us in giving us real feedback around this. And then ultimately, I want the industry, so, procurers, buyers of mental health care or AI tools, to use this benchmark to understand whether these LLMs or chatbots that they're putting in front of their users or their employees or their members are safe. So that is ultimately what we would like to contribute to the industry. And, we want this benchmark to be bigger than Spring Health. We co-founded this benchmark. We co-founded the council that oversees the benchmark. But we want competitors to join in. We want the entire industry engaged, because this is a problem that's much bigger than a problem specifically for Spring.
Well, April, thanks so much for joining me. Really appreciate the conversation.
Yeah, thank you.
Before we end the show, I want to remind you about some exciting events happening within the next week. TITV will be on the ground at Adobe Max in LA. Akash Pasricha will be talking to some key Adobe executives and partners about AI and creativity on Tuesday, October 28th. And the day after that, you don't want to miss the Information's WTF Summit, which is Women in Tech Media and Finance. The Information's Natasha Mascarenhas will host a very special edition of TITV from WTF in Napa Valley on Wednesday, October 29th. We're all very excited for that show. And that conference is a great one. And that does it for today's show. A reminder that we are live on this stream Monday to Friday at 10 a.m. Pacific, 1 p.m. Eastern. And I want to thank Amazon Web Services, who is our presenting sponsor for this production. And I want to thank you for tuning in. We appreciate your viewership. And I'm already very excited for the next time I get to guest host again. Hopefully they'll let me back. And we will see you tomorrow, Silicon Valley.